Welcome in to the KE Report, a special Sunday daily editorial as we are joined again by Marc Chandler. This seems to be a pretty consistent trend for us here. Marc recapping the week from the past week and looking ahead to next week. Marc is the managing partner at Bannockburn Global ForEx, also editor of the Mark to Market website, which I will post a link to in the show notes. Now, Marc, we have a lot to recap from this last week. We saw a lot of volatility in the markets, but boy, oh boy, it seems like the markets more or less celebrated almost everything that came out of last week. We have the election to talk about, Fed meeting, and also China's policy announcements on Friday. Let's start with the election. Really a sweep by the Republicans. It looks like Trump is going to be the next president of the U.S. And as I said on the market front, boy, oh boy, those markets really celebrated that on Wednesday and followed through to end the week quite strong too. Marc, what was your takeaway from that really Republican sweep of the election?
Yeah, I think what the markets interpreted is it moved it down. Like, if you think of the possibility, the distribution of the possibility scenarios, that the downside risks, I think, people are concluding have been reduced. And the implication of that is higher U.S. rates, stronger U.S. dollar, and in that environment of a still strong economy, that is extending the soft landing, good for stock. So I think this kind of like mood continues.
Well, Marc, do you think that some of the policies around regulation, or I guess less regulation, and cutting some of the red tape also are a boon for certain business sectors? Do you think that helped kind of spike the punch bowl a little bit as well?
Well, yeah, I think businesses generally prefer a lower regulation, lower taxes, and I think that's what they think they're going to get in the next administration. We'll have to see how it plays out, but yeah, I think that the kind of conservative economic agenda, deregulation, more M&A as well. I mean, I think that even 60 Minutes, the TV show, did an episode on the U.S. Federal Trade Commission and the criticism that business has. So I know that when you look at how people voted, a lot of ink has been spilled over the working class voting for Trump, that Trump made some really big inroads there. At the same time, the economic policies seem very pro-business, and I think that's partly why investors like it.
So, Marc, since Trump doesn't actually take office until early next year, and I guess with that political uncertainty behind us because it's not a contested election, just looking at what the markets did, the S&P up almost 5% just in that last week. Bitcoin running higher because Trump has been so pro-Bitcoin. Are we in this limbo here where markets in the way almost have the all clear because Trump can't do anything? He can't follow through on any policies right now because he's not in office. Is this kind of a Goldilocks phase for the markets where they could just continue to melt up into when he actually takes office?
Yeah, I mean, I think that's what I was trying to say is that it seems to me that these conclusions people are making. So even though we have no clue really yet who's going to be in the administration, what it's going to look like, what the policy sequence is going to be. There's a lot of unknowns, but the one thing that people do know is Trump will be the president. And so they make some assumptions about the kind of policy mix that's going to be coming forward from that and what it means for the economy. And I think that they think it's going to be generally very good for businesses. And so I think that's partly the market reaction. Now, I don't know about this limbo. For me, this is the one like amazing thing I think about markets is the anticipatory nature. They're anticipating an environment maybe that is more tolerant of mergers and acquisitions, lower corporate taxes. I think that this affects businesses. How businesses act this year is how they're going to partly be anticipating what's going to happen next year. And some of this, of course, has to be done with Congress, but some of it can be done with the president's signature alone.
Yeah, Marc, we've seen a lot of each administration using those executive orders with the pen to pass things, kind of bypassing the normal circuit of Congress, to put everything through the legislative branch, just doing it with the executive branch. But also we saw Trump in his prior term really go after the Federal Reserve. So let's bring in the Fed in this discussion. He wanted to keep interest rates low, and he wanted to really keep the dollar low. But then at the same time, he wants to keep inflation low, and you don't keep inflation low by keeping the dollar low, so or interest rates low. So how do you think that's going to work with? If you remember last time, the Fed was usually heckling the Federal Reserve to try to keep those two factors, low rates and a low dollar. But in the environment we're in with stickier inflation, how's that all going to square?
Yeah, I think Powell really handled the press conference after the recent FOMC meeting very well. The media kept on trying to poke at him, seeing what would he do if the president tried to fire him and this kind of thing. And yeah, I think that of course the president. I have no problem with the executive branch having their opinions. It's really whether how much influence they can have on the Federal Reserve. And, even Congress, I mean, even before this past meeting where the Fed cut 25 basis points, a group of senators, I believe, wrote a letter asking him to cut 50 basis points. So I don't think that like making your case to the Federal Reserve, and some people, like maybe the politicians, have a sort of a better forum to try to make their case. I don't have a problem with that. But I think that at the end of the day, I think the Federal Reserve is, at the end of the day, nonpartisan. And by that, I mean that it doesn't favor one party over another. It's sort of like some economic principles that it's trying to follow. And the idea, for example, that the Powell had repeated that while the budget, while the deficit is sustainable, the debt is sustainable, the path that we're on is not. And I think that I mean, remember, Powell was first appointed by Trump as chair. And I think that most economists, whether they're whether Democrat or Republican, would agree with that assessment. So I think there's a bit of a technocrat function at the Federal Reserve, but I think that the Federal Reserve has left enough uncertainty about what's going to happen at the December meeting. The market's got a little bit more than a 50% chance of another quarter point cut in December. But what they've really done is reassess. Powell wasn't going to be enticed into talking about what this or that Trump policy might be, these hypotheticals. But I think the market has taken away from the possible policies or sort of the scenarios to have reduced, instead of the Fed cutting 100 basis points next year, like the September dot plot showed, maybe they cut only 75. Not a big change, but just on the margins, thinking that the Federal Reserve might cut interest rates a bit less than they would have otherwise.
That is somewhat significant, though, for the rest of the world, isn't it? Because on the back of the election and throughout the week, we did see weakness in international markets. Also, because Trump is thought to be very tough on other countries with tariffs, with just tougher policy. Does that mean other markets around the world could continue to struggle, considering the Fed might not be cutting as much?
Maybe, but I think that like some countries like the ECB have been cutting independently, really, of the Federal Reserve. And even look at Canada. Amazing to me that the interest rate that the U.S. offers over Canada to borrow for 2 years is over 115 basis points. And that means that there's a generation of people that haven't seen that before. This is the most the U.S. offers over Canada since 1997. And so, so I think that countries have acted independently of the Fed. And so I think that maybe some emerging markets might feel more constrained. But I think that the takeaway from the Fed, possibly markets thinking less cuts next year, is just a switch from markets that are leading the Fed, aggressive Fed cuts, to now being under the Fed, or less dovish than the Fed. So it's quite a reversal here. I think it's really just a reflection. I think, there's this ancient Greek philosopher who said if he has a long enough lever and someplace to put his feet, he'd be able to move the world. And I think that's the problem we have right now. There's just no place to put our feet. Politics are very fluid. It's not just in the U.S. The German government looks like it's collapsed. The chancellor doesn't want to have elections until March, and they might force him to have elections sooner, maybe even as soon as January. The Irish government, parliament was dissolved. We only have snap elections at the end of the month. France, I mean, at this time we have this geopolitical uncertainty and re-election of Trump. Europe is particularly weak. Germany, I was talking about France, Macron is really a technocrat government underneath him. Very difficult to make decisions. So, I think that this is broader environment of Trump being elected, the downside tail risks may be reduced a little bit in the U.S. favoring the U.S. At the same time, it looks like Europe is shooting themselves in the foot. And before the markets open, or around the time the markets open on Monday, the Japanese Parliament might vote on their own prime minister, and it could end up that the Japanese have a minority government, and that because the opposition can't be united, can't figure a way to come together, and that allows the LDP to have it still. So it's a bit like what's happening in Canada, huh? Where the BQ and the Conservatives want a new government, and yet the Liberals are able to just barely hold on because the NDP doesn't want to leave them. And so I think same kind of story. If the opposition were united, they'd be able to make a big change. But because the opposition, the differences among them is so great, tough to challenge the status quo.
Well, Mark, how does that tie into the currencies picture? Because all week long we've seen the dollar go higher when so many people were expecting the dollar to keep dropping. Some of that's on the back of the expected business boon in the United States moving forward with the Trump administration and the fact that there's less uncertainty. But when you look at how the dollar is paired against other currencies, a lot of these problems overseas are also causing those currencies to struggle. So what do you make of the currency lay of the land?
Yeah, I think you're right. The dollar's had a good week. And I think most of it is on the back of the election. We had a pullback before the election. But in some ways, this is also an extension of what we've been seeing, too, as far as a broader trend. For example, sterling hasn't really risen on a weekly basis since the end of September. So this is going to be the sixth consecutive week sterling's under pressure. And I think we find something like, say, with the Australian dollar, too, a similar type of story where this has been a fairly steady decline. Aussie might be able to escape it this week, sort of out of the bubble now, but it's been down for the past 5 weeks. So I think that broadly speaking, on the margins, people are going to be expecting somewhat more fiscal stimulus, more expanding fiscal policy, and therefore somewhat tighter Federal Reserve policy. And that policy mix is good for the currency, the dollar. And also, when you look at these, I was mentioning with Canada before about the 2-year interest rate differential, but the same is true with Europe. And the U.S. 2-year interest rate premium over Germany had fallen to about 135 basis points back in September. And now it's back above 200 basis points. And so, in some ways, it sounds kind of simple to say this, but allow me to say that the markets are actually paying you more to be long the U.S. dollar. But why is the dollar going up? Because people have been incentivized to buy the dollar because U.S. interest rates have risen. And it's through the rising interest rate differential that the forward is set, which is how people are paid in the currency markets.
Interesting. Well, Mark, you know how much we like talking about resources. Then resources have gotten hit on the back of that election. It bounced a little bit back during that Fed meeting day on Thursday, but then are also getting hit on Friday. What's your takeaway from this deregulation that everyone thinks Trump will go through? How that could impact markets, but then taking into account, again, this higher dollar, higher interest rates, better market environment?
Yeah, I don't know. I think it's hard to distinguish between like short term, like fancy short term ideas the market might have and longer term development. So if say we just accept what Trump does, cuts taxes, imposes some tariffs, then what happens? I think there's so many unknowns, like how the rest of the world responds. But if you think that like a pro growth strategy in the U.S. under Trump, and the Chinese seem to be slowly or gradually edging into their own pro-growth approach. We've got to wait for more details about what's coming out of the National People's Congress. But if you think that the world's two biggest economies are going to be sort of more on a stronger pro-growth course, then I think it makes sense to think that the natural resource sectors do well. The Chinese reported that when they reported their reserves earlier this week, they indicated that the PBOC did not buy gold. I think it's for the sixth month in a row. And it's kind of interesting what's happened with gold as the U.S. interest rates have shot up. Gold has pulled back in the past few days. I'm thinking that as long as we hold above 2,600 in the spot market, gold will still look attractive. I think it's really if we get below 2,600, maybe a deeper correction's at hand.
Well, invoking China and all the news that came out today and all the news people are still anticipating, what do you think the balance is between their fiscal policies and their monetary policies with the People's Bank of China? What are they doing to stimulate their economy? Should other markets, respond, in a positive way, or is it a more of a wait and see mood? How are you looking at the Chinese factor?
So Chinese have so far relied primarily on monetary policy. Many were hoping that there'd be some fiscal policy initiatives to really boost domestic demand within China. Uh, and so far, from the National People's Congress, we really haven't seen it. We've seen some more details about part of the effort has been, it's really been a threefold or fourfold effort here. One is to support like the state finances. That's in China, a lot of the debt is in the regional hands, much more so than in the central government's hands. And there's a lot of lack of transparency and off balance sheet exposures. And as the Beijing wanted to stabilize that, make it more transparent, put it on a more solid ground, wanted to support the property market, wanted to support, well, in addition to the property market, wanted to support the stock market. And fourthly, seeing that they did want to boost domestic demand, and which includes consumption, but it's not just consumption. And I think that's what we're really waiting for is to see what comes out. But I think that the market's kind of fickle, and China seems to have thrown so much stuff at it, at the generalized problem. But I think that there's many critics of China who don't think that this is going to be successful. Maybe China's thinking too small of a scale, but many think that without regime change, that the Chinese system itself is inherently flawed. And so I think there's a general skepticism, especially when you think about how many times now people feel like they've been burned, thinking that the bottom's in place in Chinese stocks or a Chinese broader economy. Come in and buy Chinese stocks, they get a few days of satisfaction or a short period of time, and then sells off again. And so I think that just like sort of builds some scar tissue and reluctance to jump back in until you really see what's going on.
Mark, can you make the call? Would you make the call that longer term the market has shifted in China? China broadly, their economy has shifted and they are no longer that beacon of growth that they were for the last few decades here?
Oh, for sure. I think that most people would agree with that. Partly what happened is that how you get this one-off surge in productivity, huge growth in the economy, comes when you move people from countries, rural agriculture to cities, urban factories. And that process, that sort of urbanization of the Chinese population, that happened. And so now instead of just a sheer number, it's got to be productivity advancement and the integration within China. And so that's the challenge really is that China, sometimes in the development literature, they talk about the middle income trap, that countries can get to a certain level of GDP per capita and then they get sort of stuck, which is why you don't have so many new entries into the high income sort of pool of countries. Many countries sort of get stuck in this middle income trap, not being able to get to that high income state. And China has some of those same things, and which is really not so popular perhaps now, but that Nobel Prize in economics went to people who focused on these institutions that help promote the growth. And they might not all be there in China's case.
Well, Mark, we often hear that there's two countries that are going to step in and fill the gap in Chinese growth, and that is India and Mexico. In India, huge population base, but not the same type of top-down government that can just push things through, and a little bit different as far as the population, as far as, kind of mixed currents. With Mexico, we just had an election there in October, and with Claudia Sheinbaum in there now as the president and her 100-point initiative in Mexico, a lot of people think that they may turn to the U.S. to say, hey, we'll fill that manufacturing void in Mexico, that China, if you want to put tariffs on Chinese goods, maybe we can do it in Mexico. We have that agreement coming up with the U.S., Canada, and Mexico this next year. What do you think of those two ideas, the potential of India or Mexico to fill the gap?
And maybe to some extent, but I think to me, two things. One is India hasn't really, so I say it's a bit early that India hasn't really fully been integrated in the world's capital markets. And because it's not really a large exporter of goods, it's really been, when you think about what India exports, it's not so much goods. And so they have to really, so what India has to do is develop that manufacturing base, which is difficult just on a competitive grounds. I think with Mexico, you raise a good point. I think that the challenge here is to say, since COVID, we've talked about nearshoring and onshoring, reshoring, all this, talking about like how we're going to bring back production and how when we say bring back production, how close does it have to be? And I think that when it comes to what's been accepted is, I think under, say, Biden, has been that nearshoring, that with the USMCA that Trump negotiated, that this helps keep domestic content rules high. And so companies things that are produced in Mexico could be exported to the US on favorable terms. And it turns out, who does this? Large US companies, primarily. And the challenge, so that the issue then becomes, is this good enough? And Trump says, no, it's not. Trump has been very critical of particular car companies who produce cars in Mexico and export them to the U.S. Partly in fear, of course, that this is going to be the back door for Chinese cars. So I think that the challenge in Mexico is, up until now, I think Mexico's development strategy, say since the mid-90s tequila crisis, that Mexico's strategy has been deepen the integration into the continental market. That's how Mexico is going to prosper, and it has. And now I think that what Trump is talking about with these tariffs on Mexico, and whether we want to have onshoring, that nearshoring is not good enough anymore. How this challenges Mexico in a very profound way. In fact, in the latest issue of The Economist, they have a good, thoughtful article about precisely this, about how exposed Mexico is to the U.S., how much the U.S. demand, even if it's from U.S. companies in Mexico, how that really fuels Mexican growth.
Oh, a lot for us to look forward to next year. Maybe look forward to, maybe not look forward to, but boy, oh boy, it's going to be sure interesting to see what comes out of the political side of things in the U.S. and around the world. Mark, we just had a very busy week here, which, as I said, caused a lot of market volatility. What are you looking for next week that could move markets?
Probably the most exciting thing that's going to happen next week is going to be the U.S. CPI numbers. And the thing to keep in mind with the CPI is that it tends to be more volatile than the PCE deflator, which the Fed targets. And a lot of the year-over-year rise really has to do with what happens to this month's rise compared to the year ago's rise. So it's really like partly as one number gets dropped out, you add a new number to take the 12-month comparison. And so even though the headline CPI might only rise 0.2%, which is fairly tame, it'll be because of what happened a year ago. The year-over-year rate is likely to pop up to 2.6% from 2.4%. Fortunately, the core rate will likely be steady or so at 3.3%. And I say or so because it depends on the rounding. So I don't think it's going to have a big reaction in the market, even though it's a bit firmer, say that the downtrend might raise some eyebrows. But I think that what's going to happen is, and I think Powell gave us already like pre-warned us about how the Fed would think of it. He recognized that this base effect that I just briefly described was that they recognized that, and he said it's going to be bumpy, and they didn't expect that 1 or 2 months would change their general view that inflation is in fact on a downward trend towards the target. He didn't claim victory. He was very explicit about that. That seems to be where we're headed, is sometime in the first part of next year to have the sub 2% headline CPI print.
And all eyes on inflation and jobs data. I guess that will be really the focus as we head through the rest of this year. Let's see what these markets do, though, because boy, oh boy, they sure got rolling this week again. And we even saw Bitcoin, a number of other sectors really benefit from the election results and what the Fed had to say on Thursday. Again, Marc Chandler, managing partner at Bannockburn Global ForEx, also editor of the Mark to Market website. Click that link in the show notes to follow along with Mark. Mark, great chatting with you. I hope you have a good Veterans Day down in the U.S. and to all our Canadian listeners, a good Remembrance Day. Thanks for your time today, Mark.
Thanks. Good luck to everybody.